Hello and welcome to a brand new show of Market Makers, the show on which we will debate, discuss, ideate, and understand what is the way forward for financial markets. We are indeed living in interesting times. The fear of inflation has subsided, but it is not over. Growth is threatening to slow down, and there seems to be a complete swing when it comes to positioning of China, which is working to India's advantage. The fact that Indian markets are outperforming, is the outperformance here to stay? Let's discuss all that and much more with a very special guest, the one and only Mark Mobius, who needs no introduction. I've been interacting with Mark from nearly 20 years now, and his ability to call up long-term trends, connect the dots, and talk about where markets are headed is absolutely brilliant. Mark, my friend, so nice to have you back on ET Now. Which part of the world are you joining us from this time?
Thank you very much. Nice to be with you. I'm now in Dubai. I just arrived from New York a few days ago.
So Mark, when you were in US, I'm sure you must have done a quick back of envelope calculation on the impact of inflation and how real is the inflationary problem, at least in United States. What is your understanding based on the comments what we got from Fed at Jackson Hole? Do you think we've seen the back of inflation?
No, we have not seen the back of inflation. But the interesting thing is in the US, and by the way, on this trip to the US, I visited 5 different states. I was in California, I was in Texas, I was in Nevada, and of course, New York, and a number of other states. And what I noticed was that spending is still very high. If you go to any of the tourist spots, we went to Mount Rushmore, we went to Grand Canyon, it's packed with people. That's number one. And number two, gasoline prices at the pump have been falling in the US because the government has released its strategic oil reserves, which have pushed the prices down. But nevertheless, the oil price is not going to go down dramatically, and it's still much higher than it was previously. So I expect the inflation to continue, particularly when you see the spending that you have in the US. And therefore, the reaction of the central bank will be to raise rates and continue to raise rates. But in the US, it's not as bad as what you see in Europe, where the Europeans are really facing a very, very dire situation with inflation going through the roof and the central bank being forced to raise rates in the face of very, very dire fuel supply problems.
Mark, so if you've not seen the back of inflation and if inflation is here to stay, are we in for perhaps more challenging times before it gets better? While equity markets may have run up from the recent low, the question is that is this as good as it gets for this year now?
No, I think it'll get worse because I believe the Fed will continue to raise rates because they realize that inflation is still too high in their view. You must remember, central banks, their playbook is to raise rates whenever they have inflation. And so they're going to continue to do that, I believe. And you're going to see higher rates in the US and a slowdown in the economy. Nevertheless, what you see in America is also an incredible amount of savings that have been fed into the economy. And of course, the current administration is pumping more money into the economy by giving, for example, a break people that have loans, student home loans. They're helping them to pay that back. So that's more money going into the economy. So it's a touch and go situation.
Mark, why is India outperforming? Some would argue that Indian markets are expensive, and if interest rates go higher and if inflation is here to stay, then that automatically should impact the P multiple for India.
Well, you must remember that if you compare countries around the world, India looks very, very good, particularly if you look at the big countries. And you have to compare China and India. As you know, China is going through a terrible time now, and the market is very bad. The performance has been very bad, and it looks like the economy in China will continue to be in a bad shape. Uh, on the other side, and by the way, exports are very important for China, whereas for India, they're in a much better position because, yes, you have software exports, which will probably continue to do very well in the face of the effort globally to become more productivity, increase productivity, and become more efficient. That means the demand for Indian software will continue to be high. But more importantly, the Indian economy is not so much dependent upon exports, upon manufactured exports. And that's good news because you have a domestic economy which is very large and which can feed the growth of companies in India.
Mark, last time when we spoke to you, you had 3 positions in India. Have you made it 4 or have you cut it down to 2?
No, we continue to hold what we have, and we will probably increase as things go forward because, as you know, a lot depends on the status of flows into funds. So into our fund, of course, the flows have been not that high because of the current situation. But as those flows increase, we will be increasing India.
When you speak to your clients and your investors, are they looking at pulling out of their commitment from China? Are they ready to buy into Indian equities even at these historically high averages, or even at a time when market valuations are above average?
You must remember that the reciprocal of the price earnings ratio is the inflation rate, of course. So as inflation rises, as interest rates go up, the PE ratio has to be adjusted. But generally speaking, what we're finding is that people are down on China, and up on India. And the reason for that is that so many of them have been burned with their investments in China. In fact, we were in a meeting recently, and the first thing the client said, "Don't talk to us about China." So a lot of big institutional investors have been burned badly in China, and therefore they're avoiding it. And of course, the alternative is India and other countries around the world.
So Mark, as we look into the future, one side there is the inflation challenge, on the other side there is fear of a hard landing stroke recession. What would be the dominant feature which will influence the script of how financial markets will move for next 6 to 12 months? Will it be fear of inflation or will it be fear of recession?
I think it would be fear of inflation and therefore fear of high interest rates. As you know, as I mentioned, the central banks will continue to raise interest rates, and therefore concomitant to that is, of course, inflation. So if people see inflation continuing at a high level, then they will assume that interest rates will continue to go up, and that will be bad for the markets, at least temporarily. And by the way, very important to look at the historical perspective, because high interest rates do not necessarily always mean low equity markets. So we have to look at that very carefully. Of course, the impact on bond markets is very high, but on equity markets is something different.
Mark, why is the money market telling us a completely different story? And if I look at some money market watchers, especially global bond fund gurus, they are making a case that, look, the money market is a mature market and the US bond yield, both short term and long term, has inverted, which historically has pointed to a recession.
I think that's one theory, and I think it's quite possible that we will enter into a recession. There's no question about that. Of course, Europe is already almost into a recession already. So depending on how you define a recession, we're definitely in that situation in Europe. And it could spread to the US. But you must remember there are elections coming up in the US. And the Democratic Party will do anything possible to have the economy in good shape when the election comes around, which is why, for example, they released the strategic oil reserves in order to reduce gasoline prices. As you know, gasoline prices at the pump in the US is a very, very important factor because so many people depend on their automobiles to move around.
Mark, one of your big positions in India was Persistent, which was an IT company. And historically, we've seen that whenever there has been a slowdown, at least in developed economies like Europe and like US, it has historically impacted IT companies. What are your thoughts there, Mark? Would you be relooking at your exposure to IT and Persistent in particular?
I believe in the case of Persistent and other IT companies, their future looks very good even in the face of recession for one very simple reason. Companies and organizations need to increase efficiency, and the way in the face of the recession. And in order to do that, they've got to take advantage of IT services to a greater extent. So I expect expenditures on IT will probably increase when there is a recession.
Mark, I'd like to draw your attention to the internet stocks, especially the fintech companies globally, names like Tencent, Alibaba, SoftBank, and then Indian companies like Zomato, Policybazaar, Paytm. Do you think this was a fat Humpty Dumpty bubble which has got pricked?
Yeah, I think it's probably a good description. In the face of higher interest rates, these companies that have not been earning money and are in debt are going to be in trouble. There's no question about that. So I think these are companies that should be avoided. Now, not all of them are in that situation. In the case of the Chinese companies you mentioned, their downfall is because of what happened to them as a result of moves by the administration in China to hinder their development, or at least to constrain them. But any company that has not been making money and continues to burn money will be in big trouble, and these are companies to be avoided.
Mark, so what do you make of the crisis in Europe? Given the fact that right now, in Europe, you have to choose between eat or heat. There is inflation on one side, which is having impact on your spending power, and there are high energy prices, which are sucking out the savings and which are having impact on your energy cost. The problem in Europe on all count is real. And now that winter is coming, what kind of economic ramifications do you think that will have on financial markets?
It would be very bad. And you can look at the euro as one example. The euro now is, I think, it's 90 something cents against the US dollar. And that shows you, it come down from 120 or 120 plus. You can see that the euro has really been bombed out. And I believe it's an indication of confidence in Europe and the euro. So Europe is in big trouble, and they will continue to be unless they get alternative sources of energy. It's not just a matter of the price of gasoline or diesel at the pump. It's a matter of supply to industries. Some industries in Europe have to shut down or at least close down, close some of their production because of lack of energy or because of higher energy prices. So this is a real crisis in Europe and will probably get worse during the winter season.
Mark, what is your view on Reliance? This is a company which you've tracked for many years now, and I think you've owned Reliance in the past, then you sold it, then you bought it back. Interesting things are happening now. Here's one company where they've got their, they've managed to really expand their operations in telecom, retail, new energy now. What is your view on Reliance specifically?
Well, we are focusing on the smaller and medium-sized companies, so we don't have Reliance. But I must say, I have to admire Mr. Ambani for what he's done with that company. and the way he's expanded it and got into new areas and really have benefited the Indian economy to a great extent in telecoms, in retailing, and so forth. So it's a very admirable company, but I don't have any specific idea regarding their growth and earnings going forward.
Mark, so if you really have to prepare your portfolio and you have to bulletproof your portfolio in this inflationary environment, what is the best hedge? Should one buy into commodities? Should one add gold back? Is it time to increase exposure to hard assets?
I think the best alternative and the best protection now would be equities in companies that have a high return on capital, have good earnings growth, and have no debt or at least very, very low debt. I think companies with those three criteria should do well in this kind of environment. Because you must remember, at the end of the day, equities, good equities, companies that are earning money, are the best protection against inflation because they're able to raise their prices in line with their higher costs and in line with inflation.
So, Mark, at the current juncture, what would you call as your high conviction bets, and where do you think both locally, both globally, and specifically in India, it's time to take some chips off the table?
Well, in India, if you look at our portfolio, we would not take any chips off the table at this stage of the game because we have companies that we think will weather well in this environment. But globally, what we would look for are companies that have a very good handle and good control on IT. Now, it doesn't necessarily mean specific IT companies, software companies, or hardware companies, but it means companies that are able to use IT to increase their productivity. So whether it be consumer, whether it be transport, whether it be manufacturing, whatever industry, those companies that have a good handle on IT and are able to increase their productivity using IT will be the targets for us.
Mark, but in general, do you think next 3-4 years are good for equity markets and especially Indian equity markets? And if I say the anticipated return from Indian markets from the current juncture in next 3 to 4% should be in mid-teens, will that be a fair statement, or that would be a very bullish assumption?
Well, if you select companies of the type that I've just mentioned, equities will beat inflation simply because the companies that are in good shape will be able to raise their prices higher than inflation. So that's the reason why equities always are a very good bet in an inflationary environment. Yes, there'll be times when the prices of these companies go down and fluctuate, but these companies, though, are going to be the survivors, and they will do very well in the long term.
Mark, what is your view on gold? Given that gold has a reputation of being a hedge against gold, this time, unfortunately, even though inflation is at a record high, gold is not living up to its reputation. Why, and what is your view there?
Well, I think one of the reasons why gold has not done better than what we would expect is because of cryptocurrencies. People are going into cryptocurrencies as a replacement for gold, thinking that it's a good investment. But at the end of the day, if you look at the long-term trend, in an inflationary environment, gold will be a very, very good safe haven. So I always recommend people to have at least 10% of their assets in gold as an emergency currency in case something goes wrong. And if you look at the way money has been printed, devaluation of currencies will continue. And you must remember, inflation is devaluation of currencies. The reason why we have inflation is because currencies have been devalued.
Mark, what is the biggest risk to this market? Is it valuations? Is it inflation? Is it this entire challenge what we have on the energy front?
Well, the biggest risk at the end of the day is currency devaluation because the way governments have been imprinting money means that their currencies will be devalued, and that can lead to very high inflation and a general breakdown of the economy. So at the end of the day, that's what we're looking at, the biggest risk.
Mark, equity investing is all about long-term planning. But I want to understand from Mark Mobius, my friend, is that Mark Mobius is not 60 plus, he's 80 plus. And he's still going. He is one of the most brilliant investors I've met. You are actively investing, you're actively traveling. What keeps you going, Mark? What is the secret sauce here? Is it yoga? Is it meditation? Is it diet?
Well, I think it's curiosity. I love to learn new things. I love to visit places to see what's going on in different countries, and that's what really keeps me going. The curiosity that I have is unending. I continue to find new ideas, new concepts, new products that interest me. For example, I was in New York at the Metropolitan Museum of Art, and I was really fascinated by how now archaeologists are reconstructing how statues in the past were actually. Because you go to a museum and you see these beautiful marble statues and you forget that these statues were painted. Originally, they were painted. Now, archaeologists are beginning to reconstruct that. So to me, that's the kind of thing that's very interesting to me.
So if Mark Mobius of 2022 meet Mark Mobius of 1985, 35 years ago. So what will you tell Mark Mobius of 1985?
I would tell Mark Mobius to continue to do things that you love. Don't do things that you are not interested in or that you don't love. Avoid drudgery. Keep happy about things that you're learning. Continue to learn. That's the key.
Mark Mobius, always a pleasure to have you on ET Now. Thank you very much for accommodating this interview request. On behalf of everyone from ET Now, once again, a big thank you. Stay fit, keep inspiring, and we want to keep learning from you.
Thank you very much. It was a pleasure.